I have spent more than 60 years around markets, and one pattern never changes. The crowd always finds a way to wrap danger in convenience. Sometimes it wraps danger in excitement. Sometimes it wraps danger in prestige. Sometimes it wraps danger in complexity, so thick and impressive that ordinary people assume the complexity itself must be protecting them. And sometimes it wraps danger in the cleanest package of all simplicity, a ticker symbol. One click, an easy promise, diversification, safety, instant exposure, professional management, liquidity, low friction. Modern investing made easy. That is the language that gets people into trouble, because once an investment becomes easy enough to buy without thinking, the public usually stops thinking. I have seen that happen with stocks. I have seen it with mutual funds. I have seen it in real estate booms, in technology booms, in commodity booms, in concept stocks, in fashionable sectors, and in every era's little financial miracle. Human beings love shortcuts, and Wall Street loves anything that can be sold as a shortcut to wealth. That is why I want to talk about exchange-traded funds. Now let me be careful. I am not against ETFs, far from it. For many people, low-cost, broad market ETFs are one of the finest financial inventions of modern life. They allow an ordinary school teacher, a mechanic, a nurse, or a young family with discipline, but limited capital to buy broad exposure to productive businesses at very low cost. I respect that deeply, but because the wrapper is useful, people begin assuming every product inside the wrapper is useful. That is the mistake. An ETF is not a magic object, it is a box. And the only intelligent question is, what is inside the box? What is the box forcing you to own? What are you paying for the box? How crowded has the box become? And what happens when a great many people decide at the same moment that they no longer want to hold it? Those questions matter a great deal more than the average investor realizes. I have watched investors buy certain funds with almost religious confidence because the fund itself had become famous. They no longer knew the businesses, they no longer studied the economics, they no longer checked the concentration, the valuation, the liquidity, the sector exposure, the fee drag, or the structural weaknesses. They bought the wrapper because the wrapper had become socially approved. That is a very expensive habit. The crowd makes this worse. When millions of people start piling into the same investment vehicle, the money itself begins distorting the thing being purchased. The flows become the story. Prices get pushed upward, not only by business performance, but by the mechanical need of the fund to keep buying more of the same underlying assets. That changes the character of the investment. You are no longer just buying earnings, assets, cash flow, and business quality. You are buying into a crowded machine whose popularity may have become one of its biggest risks. I do not like crowded machines. They work beautifully until they suddenly do not. Then the very thing that made them look safe becomes the thing that makes them dangerous. Everyone is in the same boat. Everyone assumes liquidity will be there. Everyone assumes there will always be a buyer. Everyone assumes the wrapper itself has made the underlying economics more durable than they really are. Then one day sentiment shifts, the boat tips, and the crowd discovers that an overcrowded trade does not become safer because many people believe in it. It becomes more fragile. That is what I want to explain. Not because every popular ETF is bad, some are excellent, but some of the most admired, most talked about, most heavily owned ETFs in the market today carry structural weaknesses that serious long-term investors should examine with much greater skepticism than they usually do. I am not talking about fraud. I am not saying the managers are foolish. I am not even saying the products were originally designed badly. My concern is simpler. Popularity itself has changed the economics. And once popularity changes the economics, a product can become a much worse investment than its marketing language suggests. Let me start with the first kind of danger: speculation, pretending to be innovation. This is where I would place ARKK. Now, I have nothing against innovation. I love innovation when it produces cash, earns high returns on capital, expands moats, and becomes part of a real business with durable economics. What I dislike is the market's habit of taking every exciting future idea and pricing it as though the future had already arrived, already succeeded, already scaled, already conquered competition, already justified the cost of capital, and already removed execution risk. That is not investing. That is prepaying for perfection. ARKK became famous because it sat right in the center of one of those periods when the market stopped respecting ordinary discipline. The fund became associated with explosive growth, transformative technologies, and a future that sounded too exciting to price conservatively. Money flooded in. The bigger the gains became, the more irresistible the narrative looked. Then more money arrived, which forced more buying in the underlying holdings, which pushed prices still higher, which made the performance look still more brilliant, which attracted still more inflows. That loop is not healthy. It is a performance feedback loop created by fund flows, not necessarily by durable increases in intrinsic value. When I look at a structure like that, my first question is not how much it went up. My first question is what would have to remain true for this to keep working. And with ARKK, the answer was uncomfortable. The underlying holdings were often highly speculative growth businesses. Many were unproven in the sense that the economics people were paying for lay far out in the future. Some had little or no profit. Some had limited current cash generation. Many were priced on the assumption that extraordinary technological adoption would arrive broadly, rapidly, and profitably. That is a large stack of assumptions. The second problem was concentration. Investors talked about the fund as though buying a basket automatically made the risk disappear. That is not how baskets work. If a basket holds a narrow set of highly correlated speculative growth companies whose fortunes all depend on cheap money, broad optimism, rich valuations, and long duration expectations, then the basket has diversified the names but not the real risk. That kind of portfolio is only diversified in a superficial way. The third problem was fee structure. A great many people buy ETFs because they associate them with low cost. That association is deserved in broad index funds. It is not deserved automatically in thematic active funds. A high expense ratio on top of a narrow speculative strategy is not a wonderful bargain. It means you are paying more for less diversification and more narrative risk. The fourth problem was liquidity inside the holdings. This is one of the most neglected dangers in popular funds. If a fund owns a lot of smaller or less liquid businesses, then large inflows can push those names up more than fundamentals justify, and large outflows can hammer them on the way down. The manager may be competent, but the structure itself becomes vulnerable once enough capital is chasing the same imperfectly liquid basket. Then the whole thing becomes unstable. When ARKK was soaring, people did not care about any of this. They only saw the number going higher. That is what the crowd always does. It mistakes rising price for proof of good structure. But when the environment changed, rates rose, and speculative growth fell out of favor. The same machine that had inflated the ride upward made the decline much more violent than most investors were prepared for. That is the lesson. Not that innovation is bad, not that one should never own growth. The lesson is that innovation without valuation discipline becomes speculation, and speculation inside a crowded ETF wrapper can turn into a wealth destruction device for people who think they are being diversified. If I wanted technology exposure, I would not get it through a narrow basket of dreams at a high fee. I would rather own broad, dominant, cash-generative technology companies through lower-cost vehicles or buy the strongest individual businesses directly when the price made sense. That is much more my style. The second danger is fake safety through commodity adjacency. This is where I would place GDX, the gold miners ETF. People buy it because they think they are buying gold. They are not. They are buying gold mining companies. That distinction sounds small and costs people fortunes. Gold itself is a monetary asset. It has no management team making acquisitions. It has no labor strike at the mine. It has no environmental permitting failure. It does not dilute shareholders. It does not overpay for assets in a fit of executive optimism. It does not borrow too much and discover later that the commodity cycle is less forgiving than the board presentation promised. Gold miners do all of those things. That is why buying gold miners is not the same as buying gold any more than buying an airline is the same as buying jet fuel. The input matters. The business is something else. Mining is a hard business. It is capital intensive. It is politically exposed. It is operationally messy. Management teams in the mining world have an almost comic history of destroying value at the wrong point in the cycle. They raise money, expand when the commodity is expensive, chase acquisitions, pay too much for projects, underestimate operating costs, misjudge geology, misjudge governments, misjudge labor, and then find themselves in trouble even when the commodity itself did reasonably well. That is not a hypothetical danger. That is industry history. GDX takes that entire complicated world and packages it in a way that encourages people to believe they have purchased a simple inflation hedge. No, they have purchased operating risk, political risk, capital allocation risk, leverage risk, and the possibility that gold will be right, while management teams still find ways to disappoint them. There is a second problem. These businesses often operate in jurisdictions where law, taxation, political stability, and treatment of foreign capital are far less predictable than investors from developed markets would prefer. You may have the right commodity thesis and still own the wrong mining company in the wrong place at the wrong time. The market rarely pays people for being casually correct inside structurally difficult industries. It pays them when they are right, and the business structure is also favorable. I do not think the average investor should seek gold exposure through an ETF full of mining operators if what he really wants is monetary insurance or inflation protection. If he wants gold, he should buy exposure to gold. If he wants miners, he should study miners as businesses, not as symbols. Owning a basket of miners because you are anxious about inflation is one of those moves that sounds prudent at a party and often disappoints in a portfolio. The third danger is concentration disguised as growth leadership. This is where I would place QQQ. Now, I want to be fair because some people misunderstand my attitude toward technology. I love strong technology businesses. I love businesses with asset, light economics, wide moats, recurring revenues, strong cash generation, and dominant platforms. Some of the best businesses in the modern world sit inside technology. That does not mean every technology-heavy ETF is automatically safe or sensible. QQ has become one of the most popular ways for investors to get exposure to large-cap growth, and especially to the biggest American technology names. The public thinks of that as diversification because it holds many stocks. In reality, the fund is heavily dominated by a small number of mega-cap companies. When the top positions represent such a large share of the portfolio, you do not really own a broad opportunity set. You own an expensive concentration bet on a handful of giants that may work beautifully for a while. It may even work for years. But one should at least tell the truth about what one owns. QQQ is not a neutral slice of capitalism. It is a narrow growth and tech-heavy expression of one era's winning leadership. Now, leadership deserves admiration. It does not deserve a blank check. When investors become intoxicated by the success of a group of extraordinary companies, they start behaving as though those companies can be bought at any price. They assume the growth will continue, the margins will continue, the dominance will continue, the narrative will continue, and the multiple will continue. That is a lot of continuing. I have lived through enough market cycles to know what eventually happens. Great businesses can remain great while becoming poor investments if the price paid was too generous. That is the danger inside QQ at moments when enthusiasm turns the fund into a reflex purchase. Then there is crowding. Everyone knows the names. Everyone owns the names. Every manager who wants to avoid looking foolish relative to peers gravitates toward the same names. That is one of the quiet weaknesses of fashionable funds. Their popularity becomes self-reinforcing until there is almost nobody left who can buy for fundamentally new reasons. Then sentiment shifts just a little, and the crowded positioning becomes the problem. The final issue is interest rate sensitivity. High, multiple growth businesses are, in valuation terms, long-duration assets. More of their worth is being assigned to cash flows expected further in the future. That means rising rates hurt them more. The discount rate changes and the market becomes much less willing to pay extravagant multiples for future earnings. So if I wanted technology in a portfolio, I would prefer to get some of it through broad market ownership and some of it through carefully selected world-class businesses rather than through a highly concentrated growth, heavy vehicle everyone else already worships. I do not like worship in finance. It is too expensive. The fourth danger is false diversification through emerging markets. This is where I would place EM. Now, people buy emerging market ETFs because the concept is seductive. Younger populations, faster growth, rising consumption, industrial catch-up. The story sounds mathematically superior. If the developed world grows slowly and the developing world grows quickly, then surely investing in the developing world must be the obvious choice. The market punishes surely. The first problem with broad emerging market ETFs is concentration where you least want it. Investors imagine a vibrant, diversified basket of new economies. What they often receive is a very large indirect bet on China and a handful of other heavyweights. That means their supposed diversification is actually tied heavily to political systems, state intervention, regulatory unpredictability, and governance structures they do not control and often do not understand. This matters enormously. A government that treats shareholder value as subordinate to political objectives is not a small detail. A state-controlled or state-influenced enterprise is not managed for the same reason that a well-run American or developed market-private business is managed. The incentives differ. And where incentives differ, outcomes differ. The second problem is shareholder protection. I have always cared deeply about who gets the cash and on what terms. In many emerging markets, the ordinary outside shareholder stands much further from the center of power than he does in the kinds of businesses I prefer. The accounting may be weaker, the legal environment may be weaker, the treatment of minority shareholders may be weaker, the disclosure may be weaker. All of these things are real costs, even when the GDP growth looks wonderful on paper. The third problem is currency. People love talking about equity returns while forgetting that a U.S. investor ultimately measures wealth in dollars. If the local market rises but the local currency falls hard against the dollar, the actual experience of the investor can be far weaker than the story suggested. Currency risk is not a side note in emerging markets. It is part of the main event. The fourth problem is that many of these markets are full of state priorities, capital controls, commodity cyclicality, or governance structures that create poor risk, adjusted returns despite strong national growth. People make the mistake of thinking they are buying an economy. They are buying a market. Those are not the same thing. A country can grow beautifully and still produce mediocre equity returns for outside investors. If capital intensity, governance, dilution, political interference, and valuation work against them. That is why I have never believed that fast GDP growth automatically translates into attractive shareholder returns. It often does not. If I want international diversification, I would rather begin in more stable developed markets where legal protections, accounting culture, and corporate governance are more aligned with what I want as an owner. That does not mean no emerging markets ever deserve capital. It means the average investor should be cautious about buying the dream of emerging markets in ETF form and assuming he has purchased a straightforward claim on prosperity. He has purchased a much more complicated thing than that. The fifth danger is yield chasing disguised as discipline. This is where I would place STY dividend investing can be wonderful. I respect dividends deeply. A real dividend is evidence that a business is generating surplus cash and returning some of it to owners. That is not decorative. It matters. But like all good ideas in finance, dividend investing gets turned into a bad product once people reduce it to a formula. The problem with a fund built around long dividend, increased streaks is that streaks are not the same thing as future quality. A company can maintain a streak for reasons that flatter the streak and not the shareholder. It can borrow, it can underinvest in the business, it can prioritize optics, it can operate in a weakening sector while management clings to dividend identity because the market rewards the label. That is not the same thing as real strength. There is another problem. Funds like this often become concentrated in sectors where yields look superficially attractive. Utilities, REITs, staples, slower growing businesses, defensive sectors, those can all have a place. But when too many investors crowd into them chasing income, the sectors themselves become expensive, rate sensitive, and vulnerable in exactly the way the buyers thought they were avoiding. This is how yield traps work. Investors think they are buying income. They are often buying weakness that has not yet fully confessed. A high yield can be a gift. It can also be a distress signal. The market is not generous enough to make that distinction unimportant. Then there is rate sensitivity again, a portfolio heavily tilted toward utilities, real estate, and yield. Sensitive names can behave poorly when rates rise. The dividend income does not spare you from capital loss if the underlying businesses reprice downward under pressure. That is why I do not like formula-driven dividend worship. I would rather own individual high-quality dividend businesses where I have judged the economics, the payout safety, the moat, and the management. Or I would choose broader dividend growth strategies that emphasize quality and future cash generation rather than merely past streaks. Now, once I tell people what I dislike, they always want to know what I would do instead. My answer is very boring. That is one reason I trust it. I would build around broad, market, low-cost, genuinely diversified index exposure. If I want the United States, something like VTI. If I want developed international diversification, something like VA. If I want inflation protection, I would consider TIPS directly or in an appropriate low-cost structure. Because if I truly want inflation protection, I want inflation. Linked instruments, not the operational headaches of mining executives pretending to be a commodity hedge. If I want technology, I do not need a concentrated tech worship vehicle at a moment of broad public excitement. I can get meaningful technology exposure through the broad market, because the best technology businesses are already a major part of productive capitalism. If I want dividends, I would rather emphasize quality and balance sheet strength than simply count how many years management managed to keep a streak alive. And above all, I would keep costs microscopic. This matters more than the public understands. The fee on a broad market fund may be so low it rounds to almost nothing. That is wonderful, because every unnecessary basis point paid in fees is a basis point no longer compounding for you. A good low-cost broad index fund solves so many problems at once that people underestimate it precisely because it sounds too simple to be interesting. Simplicity is not the enemy. The wrong complexity is the enemy. The whole reason these popular ETFs become dangerous is that popularity distorts the normal discipline that investors should apply. The crowd sees performance and stops asking questions. The crowd sees a theme and mistakes the theme for a margin of safety. The crowd sees many holders and mistakes that for durability. The crowd sees a ticker everybody knows and mistakes that for quality. But popularity is not protection. It is often the opposite. The more people own the same thing for the same recent reason, the more unstable the ownership base becomes. That is one of the oldest truths in markets. When I look at these 5 funds, I do not see evil products. I see products whose popularity has often turned them into much more dangerous investments than their buyers appreciate. ARK flatters speculation. GDX confuses commodity exposure with mining. Company exposure. QQQ disguises concentration as broad growth leadership. EM disguises geopolitical and governance complexity as simple diversification. SDY disguises yield chasing as disciplined income investing. Those are not small misunderstandings. They are the sort that quietly cost people 10 years of return. I have no interest in following the crowd into fashionable wrappers when broad, low-cost, durable structures are sitting there available to anyone with the patience to choose them. That has always been my approach. I do not need excitement. I need economics. I do not need a story. I need a structure that will survive my own moods and the crowd's moods too. That is what serious long-term investing is. Not chasing what looks clever. Owning what works. If a thing is wildly popular, ask why. If it became popular because it recently went up, be careful. If it became popular because it promises a simple answer to a complicated emotional fear, be very careful. If it became popular because it allows people to stop thinking and still feel sophisticated, be careful twice. The market is very good at disguising risk in approved language. It is much less good at protecting people who buy the language without studying the economics. I would rather be thought dull and get rich than be thought modern and get trapped. That is one of the few choices in finance that remains available to all of us.